Are you looking for what type of real estate asset best fits your investment goals? There are many ways to slice the real estate cake or pie. And in this video, I'm going to walk you through 5 differences between single family and multifamily investing. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book, Sell for More. So let's get right into it and talk about 5 differences between single family and multifamily real estate investing. And number 1 is financing. There are many differences between financing residential real estate like single family homes, duplexes, triplex, quads, fiveplexes, and larger multifamily real estate. First of all, the lender, when you're looking at residential real estate, the lender cares about you as the borrower first. They need to make sure your income can support the debt load of the property. Now, when we go over to commercial real estate, the lender first takes a look at the asset. Can the asset, the cash flow produced by that asset, service the debt service payments? And you as a borrower come second place. So it's a lot easier to scale using commercial financing. Then we have something called recourse and non-recourse debt. Recourse debt is where the lender can come after you and all of your personal assets if you default on the loan. With residential financing, that is almost always the case. But with commercial, we have something called non-recourse debt, where the lender will seize the collateralized asset, so that one property if things go wrong, but then they can't come after your personal assets. And last but not least, with larger multifamily properties, we have interest-only periods, where maybe for the first 3 years of the 10-year mortgage, we only pay the interest, not the principal, and that's going to improve our cash flow. And I'll put a link right up here to the video I did explaining the benefits of interest-only periods. And number 2 is improved cash flow. Anybody who invests in single-family homes, duplexes, triplexes knows that cash flow is very difficult to come by when you're dealing in that small of a scale, because you're not taking advantage of the economies of scale that come with more units. So let's say we're looking at a 100-unit property versus a duplex. Well, the expenses per unit are going to be significantly less with the 100-unit property. Your management costs are a whole lot less. The insurance costs are a whole lot less. It adds up. But with the duplex, you only have 2 units and cash flow is very, very tight. And like we talked about with interest-only payments in larger multifamily properties, that's only going to help your cash flow, and you can then put that additional cash flow back into the property to force that appreciation and improve the value of the property. And number 3 is stability. If I have a duplex and one tenant moves out, I have just lost 50% of my revenue. If I have a fourplex and one tenant moves out, I just lost 25% of my revenue. Now, if I have a 100-unit building and I have 5 tenants move out, I'm still operating at 95% occupancy. So the stability is there, and when we're dealing with larger multifamily properties, vacancy is built into our business plan. It's expected. But with the duplex, it can hit you hard if a tenant moves out. Same thing with a single-family home. What business can go from 100% revenue to 0% revenue overnight when a tenant moves out? So with multifamily, all the scale is working in our favor. We have the financing working in our favor. We have the cash flow, the economies of scale. And then we also have the stability. And then when we look at multifamily real estate in recessionary times, and I'll put a link right up here to the video I did about that, multifamily is the most stable asset in recessions. So if I have to put my money somewhere, I'm going to be putting it into multifamily, because history has shown time and time again, multifamily is the most stable in downturns. And number 4, we have structure. When you're dealing with single family homes, residential real estate, chances are you're going to be entering into a partnership with another investor. Let's say you need somebody to sign on for financing, or you need a money partner to come in, or you need a working partner to come in and actually manage it. Chances are you're going to be in a partnership type of arrangement. Maybe you're splitting it 50-50. When we move into larger multifamily properties, because of the scale, more meat on the bone, we're able to take advantage of more sophisticated structures like syndication and the fund structure. These structures are built for raising capital. So if you're looking to scale your portfolio, you have to use other people's money. Well, the structure of syndication and setting up a fund is purpose-built by Wall Street to raise a whole lot of money. Plus, there are so many benefits that come along with syndication and the fund structure for your passive investors. It's true passive investing rather than active investing like it is in a partnership. And I'll put a link right up here to the video I did talking about partnerships and how some people think that they're actually passively investing, but they're really not. And along the same vein as number 4, number 5 is solo versus team. There are many people who are able to invest in residential real estate, do single family homes, duplexes, triplexes by themselves. And this is great, but at some point you hold yourself back because you can't scale and your life revolves around dealing with tenants. But with multifamily real estate, you're building a team from the start because the scale of the property forces you to start building your team. And this is actually better for you in the long run. You're able to have people who specialize in each component that's necessary to do a multifamily deal. You may have one person on your team that specializes in underwriting. The person who specializes in underwriting isn't the person who's going to be going out and raising capital. Oftentimes, they're two totally different personality types. And same thing with property management. You're able to have on-site dedicated management staff, on-site leasing staff with these larger properties, whereas with the duplex, your property manager is going to be spread out over their entire management portfolio, and that can be hundreds and hundreds of properties. Some people like going it solo, but I know from experience that it holds you back and you're not able to scale. And if you have big real estate goals, you definitely want to start building a team. These are just 5 of the differences between single family and multifamily real estate. We have financing, cash flow, economies of scale, stability, the structure, and also solo versus team. And if you're interested in learning more about the deals I'm currently doing, head on over to callseth.com and set up a quick 20-minute phone call with me. And if you liked this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.